Now, in our previous class, we looked at how to prepare the manufacturing account and then how to prepare the trading profit and loss account and the balance sheet. So we've had two previous classes on the manufacturing account or accounting for manufacturing businesses. Now, aside from the fact that goods are manufactured and then transferred to the trading section, manufacturing businesses will more often have options of either manufacturing or buying. What I'm saying is, instead of manufacturing, you're supposed to just go and buy and then sell. But usually the cost of manufacturing is cheaper compared to the cost of what? Buying. And where we have that kind of option, the business is expected to take the option of manufacturing as against the option of what? Buying. So where we're taking the lesser option or the lesser cost option, which is manufacturing, then there's what we call the manufacturing profit or the manufacturing gain, which is the savings made as a result of manufacturing instead of what? Buying. So for instance, if the cost of manufacturing is say 10 million and the cost of buying is 12 million, if we have to manufacture, it means we have a savings of what? 2 million. And that 2 million is referred to as the manufacturing what? Profit or manufacturing gain. This class is taking us to market value recognition or manufacturing account with what? Gain or what? Profit. Now, the manufacturing profit is also called production income or manufacturing gain or production gain or production profit. Usually, this will arise where the business saves a cost by producing instead of what? Buying from the market. So if the cost of buying is higher than the cost of producing, the business takes the option of producing and as such saves some cost. So when the cost of producing is less than the cost of buying from the market, then the profit or income on production has arisen. So what I'm saying is, if the cost of producing is 10 million, I'll say it again, market value as cost of buying in the market is 12 million. If you have to produce, it will cost you 10 million. If you have to buy, it will cost you 12 million. The difference is 2 million if you produced. So that 2 million is a savings. It is a profit gain. It's a manufacturing profit that is recognized, or adjusted for in the manufacturing account to get the actual market value that will be transferred to the trading section. That income is also recognized in the profit and loss account. Now, this is an instance. If the cost of producing plantain chips for the period is 15 million and the cost of buying the same plantain chips in the market is 16 million, the business is expected to take the option of production. So when you take the option of production, you will save how much? 1 million. So in transferring the product to the trading units, we capture it at the market value of 6, recognizing the 1 million difference as manufacturing profit or production gain. That's what I'm saying. Simple. Market value of the same product you're producing. If you're producing is 15 million. If you're buying from the market is 16 million. What's the difference? 1 million. So if you have to produce, you would have saved 1 million. That 1 million is called manufacturing profit. So here we go. For instance, if the cost of producing the plantain chips for the period is 15 million and the cost of buying the chips is what? 16 million. The business is expected to take the production option to save 1 million. So what do we have? Cost of production is what? 15 million. What is the manufacturing profit? 1 million, which is the difference between the cost of production and the market value. That's if you have to buy from the market. So this is the market value, 16 million. Manufacturing profit, how much? 1 million. So apparently, you're going to transfer to the trading unit as the market value by what? Recognizing the profit made as a result of what? Producing. Now here is an illustration. Okay, in this illustration, we've already solved this question before, as you can see, but we are introducing market value into this question. You can see they said the following: are required to prepare manufacturing account for Miato Enterprise for the year ended 2018. Here are the what questions: purchase of raw materials, carriage in what? Factory rent, factory lighting, factory security, office salaries, repairs of office van, bank overdraft, direct wages, other direct expense, returns outward raw materials, opening stock of raw materials, opening stock of work in progress, factory repairs, factory cleaning, factory plant, closing stock of raw materials, closing stock of work in progress. Then I said depreciate factory plant by 10%, and then they said goods produced are transferred to the trading unit at cost plus 20%. So already we know that the manufacturing account is a function of the direct material, direct labor, okay, factory overhead, and adjusted work in progress. So let's go. Direct material here is 655,000. Note 1. So let's go. Look at direct materials. Opening raw material 230,000 is in the question. Okay, 230,000. Purchase of raw materials 540 is in the question. We have carriage inwards. It's in the question. We already know what all this means if you've been following the class. Here's a carriage inwards, 135,000. We have returns outward, 80,000. So basically, you have raw materials in store. You bought some more. That will increase your raw materials. You spend money to bring it in to increase the cost of raw material. You return some back to suppliers to reduce it. 825 raw materials available. Take out the closing stock of raw materials, 170,000. You have 65,000. 655,000. That's your direct raw material. The direct labor, you see note 2 here. Direct wages, 132,000 is in the question. Direct wages. Here. Other direct expense, 80,000. So if you add, you have 212,000. This is what you do here. So if you add note 1, note 2, which is what? Direct material plus direct labor, you have 867,000. That's your prime cost or your direct cost. So let's go factory overhead expense. Note 3. Look at it here. All your factory expenses, factory rent, factory lighting, factory security, factory repair, they are all in the question. Look at it here. Factory rent, 58,000. Look at it there in note 3. Factory lighting, 25,000. That's it here. Factory security, 125,000. Look at it here. Then we have factory repairs here, 55,000. We have factory cleaning, 45,000. They said depreciate plants by 10%. So what was the cost of plants in the question? 850,000. So 10% is 0.1 times. That's what you have here. So when you add everything together, you have 393,000. That's what you have here as factory overhead expense. The next one is adjusted work in progress. Okay. So let's go. Your opening work in progress is 95,000. Closing work in progress is what? 47,000. So take out your closing work in progress from your opening. You have what? 48,000. So that's what you have here as your adjusted work in progress, 48,000. So if you add your prime cost to your factory overhead to your adjusted work in progress, you have 1,308,000. That's your cost of production completed. But they are not saying that goods produced are transferred to trading unit at cost plus 20%. So that means that if we are taking this to trading unit, we are going to what? Transfer it at cost plus 20%. So what's the production cost? 1,308. 20% of it is manufacturing profit, 261,600. So if you add 261,600 to this, you have 156,960. That is your market value. It means that the cost of buying this product that we just produced from the market is 156,960. But we have spent how much? 1,308,000 to produce it. It means there's a gain on manufacturing of 261,600. So in this illustration, we've been able to prepare the manufacturing account, taking into consideration market value or the manufacturing profit. In this question, the cost of production was 1,308,000. But the question said we have to transfer it to trading section at cost plus 20%. So it means that the cost of buying that product that we manufactured in the market is the cost of production plus 20%. That is the market value. So the illustration helped us to compute the cost of production, compute the manufacturing profit, and compute the market value. Go through it and then hold on for another illustration, okay, that will help us to recognize the market value and manufacturing profit, in the trading profit and loss account and then the balance sheet. Okay, here is an illustration that also recognizes manufacturing profits and some other adjustments. So it's a question that we've solved already. We just brought in some twist to it via additional information. So let's go. We have from the following: you are to prepare trading profit and loss account and balance sheet as at 31st December 2018. So we have our sales, land, cost of goods manufactured. Remember, your cost of goods manufactured is derived from where? Your manufacturing account. Okay. So we have returns inward, factory plant, office rent, warehousing, motor vehicle equipment, bank loan, bank overdraft, office salaries, capital, office van repairs, discount receipt, discount allowed, opening stock of finished goods, debtors, cash in hand. So this is the trial balance. And say additional information: closing stock is finished goods 80,000. Motor vehicle to be depreciated. So depreciate motor vehicle by 25%. Accrued office rent at the 31st December is what? 30,000. Prepaid van repair is 10,000. And now say goods produced are transferred to trading unit, okay, at cost plus 10%. Cost plus 10%. Okay, so let's go. Let's prepare the trading account. Okay, so let's go. We have the trading profit and loss account for the end of November 2018. You already know how to prepare it. Turnover is a function of your sales and returns inward. So that's note 1 here. Look at it here. Turnover. Sales 2455 is in the question. Look at the sales here. 2455,000. So we have returns inward 150,000 is in the question. Returns inward 150,000. Okay, so 2455 minus 150,000 is what? 2305. That's what you have here as your what? Turnover. Cost of goods sold. Remember, is a function of your what? Goods manufactured. Okay, so we have opening stock of finished goods here is 430,000. Where is the opening stock of finished goods? 430,000. That's what you have here. Then market value of goods manufactured. They say we should transfer goods transfer to trading unit at cost plus. That means we are using market value instead of cost of manufactured. So what is the market value? Look at it here. Market value here now. We have cost of goods manufactured with 1,308,000. Look at it here. But I think we should transfer to trading unit at what? Cost plus 10%. So manufacturing will be 0 plus 1 times 1,308. So we have 0.1 times 1,308,000. So that will give us 13800. So if you add 13800 to 1308, you have 143. That's the market value that we are recognizing. Okay, so that's what you have here. Market value of goods produced 1438800. So we add it to this, you have 1868. Okay, then closing stock is 80,000. Take it out, you have 178800. That's what you have here. Cost of goods sold. Okay, now if you minus cost of goods from turnover, you have what? Gross profit. So other income. What's in your other income? Note 3. Other income here. We have discount receipt 145,000. It's in the question. Then we now have manufacturing profit, the one you're recognizing, 138,000. That's 10% of the cost of goods manufactured. That's what you have here. That's 275,800. That's what you have here. Other income 275,800. So if you add it to your gross profit, you have gross income of 792,000. So less your total expense. Note 4. What's your total expense? Office rent. What's your office rent in the question? 98,000. Additional information. Accrued office rent is 30,000 at the end of the year. Remember, accruals increases what? The expense, and then they are what? Current liability. So we have 90,000 plus 30,000. We have 128,000. Okay. Warehouse expense 125,000. It's in the question. No additional information. Office salaries 250,000. It's in the question. No additional information. Depreciation of motor vehicle 81,250. What's depreciation? They said depreciate motor vehicle by 25%. What's motor vehicle here? 325,000. So 25% of 25,000 is what? 81,250. That's what you have here. So van repair. What's van repair? What's van repair? We have office van repair 70,000. But there is a prepaid van repair. Prepayment means payment in advance. Okay. And we already said that payment in advance, we have to reduce your expense for the period, and then it's what? The current asset. So we have 70,000 minus 10,000, 60,000. Then we have discount allowed, 55,000. It's in the question, discount allowed. So when you add all this together, you have 699,250. So you have it here, total expense. So take 699,250 from your gross income, 792. So we have 92,750. That's your net worth profit. So basically, your manufacturing profit increases your what? Cost of goods manufactured, and also increases your what? Order income. So let's proceed. The next one is the balance sheet. That way you have a statement of financial position at 31st 2018. What's your balance sheet? Asset and liability. So what are the assets? We have non-current asset. Note 5. What are they? Land and building. 2,240,000. Look at it here. Land 2,240,000. Okay. The motor vehicle 243,000. Remember there's a depreciation. What's your motor vehicle here? 325,000. Less your depreciation, which is 81,250. So 325,000 minus 81,250, you have what? 243,750. The next one is factory plants, 765,000. Look at it here. Office equipment, 550,000 in the question. Look at it here. So when you add all together, you have 379,850. That's what you have, 379,850. There's no other asset, so just bring it down. 379,850. The next one is current asset. What are the current assets? Note 7. We have cash at bank. Cash at bank, 645,000. It's in the question. Cash at bank, 645,000. So we have cash at bank, 645,000 here. Debtors, 655,000. It's in the question. Debtors there is 655,000. So we have prepaid van repairs. I already explained what prepayments are. If you don't understand it, I said go to the class on prepayments. It's on YouTube. 10,000 prepaid van here. And then we have closing stock of finished goods, 80,000. It's in the question. Look at it here. When you add all together, you have 1,390,000. That's what you have here. So you bring that and add it to your what? Your non-current assets. You have 518,750. So the next one is your what? Liability. Long-term liability, note 8. What are they? Just bank loan. So you have your bank loan here, 1.6 million. If you have other long-term engagements, put it there. So we have short-term liabilities, note 9, 150,000. What are they? Accrued office rent. You know, accruals are what? Are more like amount owed to what? Creditors. So that's why it's a current liability, a short-term liability or current liabilities. Accrued office rent, we have 30,000. It's in the question. You can see accrued office rent here, 30,000. It has also increased our rent for the period. So bank overdraft, 120,000 is in the question. So we have 150,000. Short-term liability, 150,000. Okay. When you add it together, you have 1,750,000. The next one is what? Owner's equity. I already explained that your owner's equity is a function of your capital, profit, and drawings, or director's current account. Your capital is what you have invested in the business in terms of resources, and then profit is what you made as you run the business. Then drawings can be what the owner took out for his personal use. It can be director's current account as well. So your capital will increase when you make more profit, to reduce when you make losses. So capital here is 3,346,000. It's in the question. You can see capital here 3,346,000. Then profit is 92,750. Look at it here in the profit and loss account. So when you add, there's no drawings. When you add, you have 3,438,750. You bring it down here. Owner's equity 3,438,750. When you add it to 1,750, you have 5,188,750. That's your total liabilities, equal to your total what? Your total assets. Now this is wrap up a question illustrating recognition of what of manufacturing profit and the market value, you know, as it affects manufacturing account, trading, profit and loss account, and the balance sheet. We also looked at some adjustments like accruals and prepayments, depreciation. You know, we already had classes on accruals, prepayments, and depreciation. You can check that out to get more understanding. But it's the same concept they are applying here. Okay, so this basically helps us to understand how to prepare manufacturing account, trading, profit and loss account, and the balance sheet for businesses involved in manufacturing. You can go through it, and then if you have questions, reach me on 0813650656 or send me an email, jeremiah.dusu@gmail.com. Drop questions in the comment section there to reply you with the right answers. Like my Facebook page, to get notifications as we publish topical classes, from time to time. Don't forget, it's the same concept, no matter how voluminous the question may be. You can have questions telling you to prepare manufacturing accounts, okay, and prepare trading profit and loss account and balance sheet, and they'll be telling you to share the expenses between factory expense and office expense. No problem. Okay, in our question here, we gave you the factory expense directly, we gave you the office expense directly, but if they are telling you to apportion, just apportion. They can tell you apportion rent between factory and office. They can tell you 30-70. It means 30% for maybe office and 10% for factory. So just follow the instruction and apportion accordingly. It's the same concept. If you have questions, like I said, don't forget, don't hesitate to call my attention via calls, via emails, or by dropping questions in the comment sections. I'll be glad to reply you with the right answers to your questions. Thank you.